Ever wonder if there's an investment strategy that doesn't leave you biting your nails every time the market wobbles? Enter dollar cost averaging, the unsung hero of investing that even your financially savvy neighbor brags about over coffee. Stick around and you'll find out why dollar cost averaging is the ultimate stress-free investment strategy and how it's still making waves. Understanding dollar cost averaging and its core benefits. Dollar cost averaging involves spreading investments over regular intervals, irrespective of current market conditions. For example, an investor may commit $500 monthly to an index fund. This strategy leverages market volatility. Fewer shares are bought when prices are high, while more shares are acquired when prices dip, thus reducing the average cost over time. This built-in risk management helps mitigate the impact of market downturns. Vanguard's analysis confirms that dollar cost averaging can notably limit downside exposure, making it a practical strategy for cautious investors. While lump sum investing outperforms dollar cost averaging approximately 68% of the time during bullish markets due to its immediate exposure to growth, dollar cost averaging proves advantageous in unpredictable or declining markets. It helps investors avoid the pitfalls of poor market timing by establishing a consistent investment rhythm that reduces the emotional pressure of decision-making. Dollar cost averaging in 2024, a year of highs and lows. The economic landscape of 2024, marked by global uncertainties and corrections within the tech sector, highlighted dollar cost averaging stability. The year began with significant market volatility driven by geopolitical tensions and fluctuating tech valuations. This instability allowed dollar cost averaging investors to benefit from periodic lower market prices, averaging down their cost per share. A Morningstar study showcased that during downturns, such as the first quarter tech sector correction, investors using dollar cost averaging managed to lower their entry cost and position themselves for potential gains as the market rebounded. This contrasts with lump sum investors, who may have invested at higher initial points, facing deeper drawdowns. The steadiness of thus offered peace of mind and capital preservation during a year defined by sharp market shifts. Psychological peace of mind. One of the standout benefits of dollar cost averaging is the emotional stability it provides. Investing large amounts in one go can be nerve-wracking, particularly in uncertain markets like those seen, where the tech sector and emerging markets experience significant swings. By committing to regular, automated investments, dollar cost averaging helps investors avoid emotional responses, such as panic selling during downturns or over-enthusiastic buying during temporary market highs. This steady approach aligns with behavioral finance principles that suggest consistency in investing reduces stress and impulsive decision-making. In practical terms, dollar cost averaging instills a routine that reassures investors, turning market dips into opportunities rather than threats. A market analysis revealed that investors using dollar cost averaging were less likely to change course abruptly when faced with volatility, maintaining their portfolios and long-term strategy better than those who invested large sums up front. The numbers game. Real-life case studies. Consider an investor who began dollar cost averaging with $1,000 per month into an S&P 500 exchange-traded fund starting in 2023. As 2024 unfolded, marked by price fluctuations and corrections, particularly the notable downturn in March, dollar cost averaging allowed this investor to spread out their risk. By investing during lower market points, they effectively averaged down their cost per share. When the market began recovering mid-year, their portfolio rebounded more stably than those who invested a lump sum just before the dip. The data supports this outcome. While lump sum investors saw greater losses during abrupt market corrections, dollar cost averaging participants benefited from having purchased shares at various price points throughout the downturns, leading to a more balanced cost basis and smoother recovery. Limitations of dollar cost averaging. Missed bull runs. Despite its advantages, dollar cost averaging does have its limitations. One major drawback is that it can underperform during prolonged bull markets. When markets are on a consistent upward trajectory, lump sum investing often yields higher returns due to the entire investment being exposed to growth from the start. Analysis by Dimensional and other studies highlighted that lump sum investing outperformed dollar cost averaging in about 68% of modeled scenarios, especially when markets trended strongly upward. The post-pandemic bull run from 2020 to 2021 serves as an example, where lump sum investors capitalized on rapid market growth while dollar-cost averaging investors experienced slower gains. However, the mixed market conditions of 2024, marked by sharp corrections and rebounds, illustrated why dollar-cost averaging remains a valuable tool. Investors who employed dollar-cost averaging could navigate these shifts more comfortably, benefiting from price drops to average down costs and reduce overall portfolio volatility. Dollar-cost averaging versus lump sum. Comparative insights. Vanguard's 2024 review highlighted that while lump sum investing typically outperforms dollar-cost averaging in about 2/3 of market conditions, dollar-cost averaging proves its worth in specific situations, notably during volatile or downward trending periods. Lump sum investing benefits from the immediate compounding effect, especially in bull markets, where money grows from the start without interruption. For example, during the post-pandemic rally from 2020 to 2021, lump sum investors saw significant returns due to the quick and steep rise in equity prices. However, dollar-cost averaging shines when the market is turbulent or on a decline. In 2024, tech stocks faced valuation issues and significant corrections, making dollar-cost averaging a safer approach for those wary of sharp downturns. By averaging the cost over time, dollar-cost averaging investors could minimize the impact of market peaks and troughs, securing a steadier portfolio performance in unpredictable environments. Real-world example. Consider Alex, a software engineer who opted for dollar-cost averaging by investing $600 monthly into a balanced exchange-traded fund throughout 2024. His approach was tested by price peaks during mid-year tech rebounds and sharp declines in March due to economic uncertainty. While lump sum investors who entered the market at early lows might have captured higher returns during temporary rallies, Alex's strategy insulated him from significant market shocks. By averaging his investment over time, Alex avoided the stress of major price shifts and maintained a resilient portfolio. Why dollar-cost averaging suits everyday investors? For the majority of investors, especially those earning steady paychecks, dollar-cost averaging aligns well with natural cash flow and investment habits. Most people don't come into large lump sums. Instead, they accumulate savings over time. With rising interest rates affecting savings accounts and increasing the cost of holding cash, dollar-cost averaging allowed many to start investing without waiting for an ideal moment. This approach proved especially useful for those who wanted to stay flexible while building their portfolios, bypassing the pitfalls of market timing and the psychological pressure to invest at the perfect time. Dollar-cost averaging's simplicity and adaptability make it a favored strategy for novice and cautious investors. It encourages disciplined investing, prevents panic-driven decisions, and capitalizes on lower prices during market dips, critical qualities that resonated with many in 2024's unpredictable financial climate. Tips for maximizing your dollar-cost averaging strategy. Automate investments. Automating your dollar-cost averaging contributions can ensure consistent and disciplined investing without the need for active oversight. This automation, as highlighted by financial platforms, has become a key feature for building long-term wealth, allowing investors to maintain their strategy effortlessly. Keep perspective. While dollar-cost averaging is not guaranteed to outperform in every scenario, especially during strong bull markets, it serves as a shield during downturns. The tech sector corrections demonstrated that investors using dollar-cost averaging were better protected against steep losses compared to those who relied solely on lump sum investing. Remember, the goal of dollar-cost averaging is stability and long-term growth, not necessarily to chase high returns. Annual reviews. Even though dollar-cost averaging is a set-and-forget strategy, it's wise to conduct annual portfolio reviews. This practice allows you to adapt to shifting market conditions, reassess asset allocation, and ensure your investment approach aligns with any changes in financial goals or market trends. That's all for today's video. If you found this breakdown on dollar-cost averaging insightful, don't forget to hit that subscribe button and give this video a thumbs up. Your financial future starts with informed choices, so stay tuned for more expert insights.